There's a very well-defined technical setup right now taking place in the S&P 500, and I wanted to zoom in a little bit today on the charts and show you the not only the pattern or the formation, but the reward to risk and the specific profit targets and where you'd stop out. I think we're going to go straight to the charts and kind of give you an idea on this, and we'll keep it right to the point. So what you're looking at here is the SPY ETF, which, if you don't know, it represents or tracks the S&P 500. And what you can see is that, of course, we had a massive rally off the lows of the March lows. Quite frankly, certainly much further than I thought it would ever go. But, you adapt to the markets and you start respecting the things that work. And that's ultimately how you make money, if you're flexible and you're able to change your mind. Now, we have a lot of longer-term structural problems in the economy, and those will ultimately come home to roost, as one of my former bosses, Jamie Dimon at JP Morgan, said last week in the conference call, is that we are seeing a very unusual recession the way it's playing out. It's everything kind of gets delayed. And so near term we could see more upside, but I think ultimately once at some point in 2021, I would guess we are going to probably have some bigger problems we have to deal with. But for the time being, there's a technical setup that looks very interesting. So let me get rid of one or two more lines here. And again, very strong rally off the lows. Then we topped out in early June, and then we started to consolidate. And if you were to look at and I'm going to keep it to the S&P here, but if you were to look at other parts of the market, like healthcare, like other parts of consumer discretionary spending, we are seeing a lot of the same type of formations where the market rallied into early June, then it's been consolidating largely sideways, and now it's ready to go again. And what's particularly interesting here on the S&P 500 is that it has a very well-defined potential next upside target. And the way we look at that is we look at where the market gapped down from in the month of February. So if you go back here to where the market was in the month of February of this year, and I'm going to zoom in as much as I can so you can see this very well. At the point here, the day specifically was February 24th, and on that particular day, the S&P dropped. Let me see if I can get you the measurement tool. I think it's this one here. On that particular day, the S&P dropped by 3.25%, which ultimately, of course, gave way to that big sell-off we saw into the middle part, second half of March, and then ultimately the big ricochet back. But now we have been consolidating below the June lows for some time, and it looks like the June highs, and it looks like we are wanting to, the machines are looking to push the S&P back to at least from a target perspective, that upper the closing low of February 21st. Had to give that a couple attempts. And so basically, the way we measure this right now, we're just going to look at how much more there is left from here to where the market closed the other day to the upper end of the gap, and it's roughly about, let's call it 3% to round up. So if we were to see another squeeze higher, that would roughly be about where I would imagine we could see the S&P squeeze to. It can certainly go lower, it can certainly reverse, but I think the reward to risk here, because you have to keep in mind there's a lot of algorithms that look at the same thing. A lot of people, one of the questions about technical analysis is, does it work because it works, or does it work because everyone's looking at the same thing, right? And so it becomes a self-fulfilling prophecy. Honestly, I don't know. I suspect it's a little bit of both. But that's would be the next upside target. So you're looking at a gap fill on the SPY that's roughly 333. I think in terms of a stop loss, one of the things that's been holding very well is a very simple 21-day moving average. If we go below there, which is currently about 313 on the SPY, I would probably get a bit more cautious. Or you can even get out as soon as we get any sort of bearish reversal on a daily closing basis, like a down day of 1.5% or so in the S&P. But I think right now, and this is just the S&P, we can look at many other charts that look very similar. Again, a lot of them have already broken higher, and even though I think the upside is ultimately somewhat limited for the time being for the summer, this just increasingly looks like something that the market wants to do. So, one of the things I'll talk about in one of the upcoming videos, and maybe I'll start doing like a monthly video on this, is the need for you to be able to change your mind. I did not, and I'm on the record for this, I certainly did not see the market rally as much as it did all the way through early June. No way. I never thought we would be here. But as new information comes out and you start to understand, what the market's focused on, what the latest tale is, what the algorithms are looking for, what investors are looking for, both on the institutional side and the retail side, and you start to see things. And right now, it just looks like the path of least resistance, all else being equal, is at least somewhat higher for right now. Again, in the summer though, you'll tend to at some point see somewhat of a cap in the market. So I don't think we have what it takes to really blow significantly higher this summer. But we will, of course, measure and map this on a daily basis, and we'll keep you in the loop. Hope it makes sense, folks. If you have any questions, comments, leave them down below. Give us a thumbs up, like, subscribe, and I'll see you soon.